COVID-19, the disease that originated in China in late 2019, has now transformed into a global pandemic. It has affected our economies, our jobs, the stock market, and our way of life. As it brings uncertainty to many parts of our lives, this series is our conversations with the companies, the players, the decision makers, to help us make sense of it all. Welcome to COL Conversations.
Hello, I'm April Tan, COL Chief Equity Strategist. Thank you for joining us in this episode of COL Conversations. We're joined by Mr. Chito Reyes of BDO, and we will discuss how BDO is coping with the current pandemic and their strategy in light of this new normal we are now facing. Good morning, Chito.
Hi, good morning, everyone. Thank you for listening in.
Yeah, and thank you also for joining us today. Maybe let's start with the question like, how are you affected by the COVID-19 pandemic and the ECQ? What services have you suspended for now, and what services remain open for your customers?
Okay, maybe first from a branch operation perspective, we have roughly about half of our total branch network that's open at the moment. More as a percentage, we have more branches open outside Metro Manila. In the case of Metro Manila, we only have about 20 to 25% of our branches that are open today. And these are all based on a skeletal workforce with shortened banking hours. We are trying to keep as many branches open as possible, except that, again, the limitations on public transport prevent us from doing so. So as of now, the good news is that we're still able to show pretty good or decent growth in our deposits since the lockdown started. And I think relatively, given that we have more branches open compared to other financial institutions, the tendency is we see long lines outside our branch locations for people who still want to do their banking transactions. To also, I guess, help our people who are operating on a skeletal basis in the branches, we've also asked our clients to do some of their usual transactions online instead of doing it over the counter. So as an example, bills payment or pickup of remittances are not effectively allowed at the moment to be done over the counter. We are asking our clients to just do it through mobile banking or personal online banking, which are both accessible. And we have seen a substantial increase in the usage of these digital channels today. Now, on the lending side, we also remain open. Our clients our corporate clients who have existing lines with the bank are still able to draw on them. We remain open for business. But I think what we have seen so far is a marked slowdown on the lending side, which again is to be expected given that a number of businesses are not allowed to operate at this time, and only the exempt businesses are allowed to continue operations even on a limited scale. So overall, net, we are still able to provide the basic services to our clients, whether it be lending, deposit taking. But I guess our clients will also ideally have to help us to cope better in terms of providing our services by also resorting to digital channels whenever they can. So that will hopefully help relieve the long lines at the branch locations.
Yeah, and one of the things we've been reading in the papers is the request for banks to, have a 1-month delay in collection of interest on loans. So, can you discuss more about this? Like, how are you helping? Like, is it like collection of the loans? Like, even the amortization, or is it no interest, or it's only a delay in collection of interest and things like that? Can you discuss this part?
Even before the Bayanihan law came into effect, we already announced a 60-day grace period for loan amortizations. So effectively, what it means is that any amortization in terms of principal or interest that will fall due during the lockdown period will be automatically extended for 60 days with no penalty. Okay. So what it does is it provides our clients leeway or flexibility to pay their amortizations when things return to normal, or if they're able to do the payment today anyway, and they don't want to have the possible burden of forgetting to pay in the future, they can still pay today, and we will still accept their payments. But for those clients who are unable to do so, then there's an automatic 60-day extension. It's not a forgiveness or condonation of interest. It's just a deferment of the payment schedule. But again, what consistent with the law, there is not going to be any penalty, no interest on interest, no late payment charges.
So this is available only for retail or corporate and retail clients?
It's for all our borrowers, both corporate and retail.
And how many have availed of this? Have you seen the data?
No, everybody today is not expected to make any payment unless they still want to. So it's an automatic 60-day extension today.
Oo. Pero kasi there might be some clients who, don't wanna, as you said, they don't want to deal with a big lump sum kasi after 60 days, and then, you have to pay a lot. So, may mga nag-avail.
Mayroong, like in my case, I had a credit card billing that's due a couple of days ago, and then I still paid it on 2 days without having to wait for that 60-day extension. I tend to forget those things, so I'd rather do it when I'm still very conscious about it, when I know it's something in my schedule and calendar.
Let's talk about the future. I think one of the reasons why there's been some hesitation in buying the banks in the stock market today is concerns that your loans are vulnerable to non-performing loans or higher defaults. I guess one of the questions of the customers today is how big a loan exposure do you have to vulnerable sectors like airlines, hotels, SMEs, consumers?
In terms of the vulnerable sectors, early on we identified basically the tourism and travel related industries, and we have about somewhere between 3 to 5% of our loan book in those industries. Now, that exposure is not totally unsecured. We do hold some form of collateral over a substantial portion of that. So that's one. The other potential vulnerable sector would be the SMEs, given that they have smaller balance sheets. Some of them may be the only business of the principal. So that may be more vulnerable as compared, say, to an SME business that is part of a group of businesses, where there are other businesses that could potentially help support the weaker sector. Now, we're trying to get an estimate of that as well, but officially, what we consider SMEs based on the BSP definition is just under 3% of our loan book, and that includes micro SMEs already. So it's not that big an exposure for us.
And consumers?
For consumer, consumer is big. That's about 22% of our loan book. But within that, within our 22% consumer exposure, roughly about 3/4, about 75% of our consumer loans are in secured products. So primarily mortgages and auto loans.
Mm.
So it's only the remaining 25% which is unsecured, and that would be in the form of credit cards, personal loans.
Mm.
And historically, our NPL ratios in the consumer lending space have typically been lower than the system average. And our experience also has been that, let's say, in the case of secured consumer loans, let's say if we may have an NPL ratio of, let's say, 1 or 2 or 3% for mortgage or auto loans, if you look at it on a net of recovery basis, because we do have the collaterals to fall back on if the borrower becomes delinquent. So since we have a fallback on the collateral, our experience has been that what we call our net loss after recoveries is less than 0.5% of our original exposure. So initially, the NPL ratio may be 1, 2, or 3%, but when we go through the process of foreclosing on the collateral and eventually disposing of that, our experience with our net loss down to less than 0.5%. So it's not as substantial as the initial delinquency numbers may suggest.
Yeah. Okay, so assuming, after ECQ is lifted and the NPLs really go up, are you considering, say, restructuring the loans?
I imagine there would be some level of restructuring required for certain sectors, especially, let's say, the tourism-related sectors. I think we will, especially, let's say, for the airlines, I think we will see some level of restructuring there, because I guess the key once the lockdown is lifted, I think what is key is to see how fast our clients can get back on their feet in terms of restarting their businesses. And again, that I think is in large part dependent also on the parameters of the lifting of the lockdown. Is it a modified lockdown? To what extent is public transportation accessible at that point? We don't know yet.
Yeah. What about on the provision side? How aggressive will you be in light of the expected increase in NPLs?
I think we will see ourselves providing more than usual, and again, in anticipation of a potential increase in NPLs. I guess where we are is that comparatively we have a higher coverage ratio to begin with. So I think we will not be as pressured to put up additional provisions compared to, let's say, the rest of the industry, with a coverage ratio of over 160%. And even if you look at stage 3 accounts in particular, my recollection was that we had the highest coverage ratio among the peer group in terms of stage 3 accounts in particular. And most of our stage 3 accounts are in the consumer space. So more than half of our stage 3 accounts are in consumer loans. So again, that is based on the delinquency rate. But if we look at it on a net recovery basis, we will actually may not need to provide as much for consumer loans now, given the experience in recovery on the assets.
So, it's early days, but would you have an idea how much higher the normal provisions will be?
I think it will really depend on our assessment of the accounts, and that's something that is ongoing. We're reviewing the different levels of exposures to. I try to identify the vulnerable sectors, and once we have a better grasp on that, then I think that will then give us an indication of how much more we may need to set up, looking at what existing provisions are, looking at eventual historical recoveries. So those are the things that will have to come together before we're able to come up with a number.
Yeah. So, one of the reasons why people like BDO is because of the strong growth of your lending portfolio. Are you still expecting loan growth to remain strong in 2020, or let's just write 2020 off, and let's look more towards 2021, 2022?
I guess if you're to compare it to historical loan growth, maybe 2020 will again be more tempered. We'll see more tempered growth this year. I think the possibility of double-digit growth in loans may actually happen 2021 or 2022. And I think that is in large part also going to depend on the lifting of the lockdown, whether it's going to be done in phases, to what extent is our businesses going to be allowed to resume operations, and how many different industries will be allowed to reopen.
I'm also wondering, yeah. Mm-hmm.
Realistically, for this year, I think maybe mid-single digit might be something to look at for now.
I'm just wondering, in light of the expected economic slowdown because of the coronavirus, have you, adopted a more conservative evaluation of possible borrowers? Did you add like certain parameters in evaluating whether or not you will lend to a client? I mean, have there been any changes?
Yeah, of course. I mean, like if a client has an existing line with us, but if let's say his business is not operating, he wants to draw on it, of course, we will tell him, I mean, we don't think it's an opportune time for you to do this transaction. What will you use the money for? He may just use the money for speculate on something. But if let's say the client's business is something that's operating today despite the lockdown, if say they're in the food manufacturing business, then they can draw their line anytime. And we haven't actually raised our interest rates despite the temporary tightness in liquidity that we saw prior to the effectivity of the reserve cuts.
Okay, on the side of the BSP, they have come out with a lot of rules that, in our opinion, is helpful for the banks. Can you discuss some of these measures and how they're helping you?
Yeah, well, what they've indicated so far is a relaxation of the recognition of non-performing loans, given that there have been grace periods applied under the biennial law. So I think what they are doing is a delayed recognition of non-performing loans. In terms of additional provisions also, I think they have indicated that they will allow a multi-year staggered implementation of provisions so that it's not a one-time impact on a bank's P&L. They've also indicated that they may relax the liquidity ratios. Although I have not seen any specific circular yet to formally implement any of those things. But generally, the tendency of the BSP has been supportive of banks, especially recognizing that there's a potential increase in the level of delinquent loan counts. They're also providing more liquidity to the system by providing a rediscounting window, specifically for SMEs. They've reduced the policy rates. They've reduced the reserve requirements. So all of those are, again, measures that will provide banks, hopefully, with the liquidity and the willingness to continue lending to the real economy so that we can continue operating overall.
And on the trading gains or trading portfolio, I remember that they also allowed a reclassification of some.
Yes, that's correct. Yeah. My personal view there is yes, it provides a relief for banks with securities exposures that are out of the money, because then if your securities portfolio has a mark-to-market loss at the moment, by being able to reclassify that into the hold to collect category, then you will effectively not recognize that mark-to-market loss in your capital position. The premise there is if it's currently under other comprehensive income at the moment, so you have an unrealized loss, and therefore that reduces your capital position for CAR purposes. By being able to transfer that to the hold to collect category, then you effectively eliminate that CAR impact. So for banks who have capital positions that will be affected by the mark-to-market position, then they will be the ones who will benefit the most from this temporary relief.
Okay. So going back to the policy rates and triple Rs, can you explain how lower policy rates and triple Rs help banks?
Reductions in policy rates are not that helpful to banks in the sense that, again, it means that there is pressure on lending rates to come down. So therefore, it is something that's going to be detrimental to net interest margins over time. On the other hand, reductions in reserve requirements free up the former deposits with the BSP into something productive, like you are now able to convert a non-earning deposit account with the BSP into a loan asset or into an investment securities investment that will give you a higher yield. So in our case, our experience has been that every 25 basis point cut in the policy rate can be offset by a 1% reduction in reserve requirements. So our balance sheet, given the mix of our assets and liabilities, that equation works for us. So far, the BSP has cut policy rates by 75 basis points, I think, while the reserve requirement has been cut by 200 basis points so far. So which means there's more policy rate cuts than reserve cuts at the moment. So again, so the initial impact is that there would be some pressure on our net interest margins. But internally, what we can do to mitigate that is, similar to our strategy last year, we have been growing our consumer and middle market loans faster than large corporate lending. And that is, so those two segments provide us higher yields compared to large corporate lending. So that's one way of mitigating that effect. On the funding side, we are also seeing higher growth in our CASA. Last year, our CASA growth was like 8% on a full year basis. But for most of 2019, CASA growth was just doing in the low single digits. So we saw some pickup towards the fourth quarter. So if we're able to continue with that pace of CASA growth, then that will also mean that we are getting more low-cost sources of funds that will finance our loan expansion. And that should be margin accretive as well.
Yeah. And then higher yields from the consumer loans, no?
Yes.
So yeah, that's a good strategy. So in general, what do you think are some of the measures you took in the past that are helping you cope better with the ongoing crisis right now?
Well, I think in terms of our digital channels, those have been ready since way before, except that what we were doing was gradually enhancing it in anticipation of higher transaction volumes, which is what we're exactly seeing today. Our problem before was getting our clients to use the digital channels. We were telling them, it's there, it's available, please use it. But not all of them did. And a lot of them still prefer to do their transactions over the counter because there's more branches, we have longer banking hours, we have weekend banking. So who needs digital banking? But now that not all branches are open, so they finally realized that it's about time that they shifted usage to digital channels. And it's there and it's working. When I look at, let's say, a Viber group that shows how many, of a compilation of what businesses are offering, let's say, food products online. And if I were to check what are the acceptable modes of payment, more often than not, I see the name of BDO there.
Yeah, the online channel, yeah.
Yes. So again, for me, the fact that a lot of merchants indicate that they are ready or willing to accept fund transfers via BDO, again, it's an indication that this wider coverage, and there is there's access, there's accessibility, there's consistency in the use of the product. And that makes us happy, because then we see that there's a high percentage usage today as compared to, let's say, last year.
So if ECQ is lifted, do you think that clients will still be using the digital channel, or will they revert back to the normal and go back to your branches?
Well, I'm hoping that this will, in a way, be say a tipping point in terms of changing client behavior. Maybe now that they realize that, why do I have to go out of the house to pay my electric utility when I can just do it via fund transfer? So hopefully it's something that now makes them realize that it's a good time to change my behavior as a consumer.
And assuming that clients do digital banking more, is there a plan to, say, become less aggressive in branch expansion or close some branches, or is it still going to be there?
Well, for us, the primary role of new branches really is to help get more people into the formal system. Because again, if we were to compare the banking coverage in the Philippines to, let's say, the rest of the ASEAN, we still have one of the lowest penetration rates in the region. And that's the reason why we continue with the branch expansion program. So we need to get more people into the fold. And once we get them into the system, one of the things that we try to do right away also is to enroll them in our online channels. So it's not, it's something that we think we will still continue with in terms of helping improve financial inclusion, but maybe the staffing of the new branches in the future may not be as much as what we have today, because if we see more and more people automatically using digital channels after opening an account, then we may not need to have as many service personnel in the branches anymore. So we may have smaller format branches in the future.
Can you discuss other measures that you plan to take to cope better with the challenges brought about by the COVID-19 crisis?
Well, internally, we are trying to provide alternative means of transport to our personnel, so that we will be able to sustain the level of branches that are open to serve the public. And we've done that in coordination with private contractors who are able to provide us, let's say, shuttle services in the form of vans or cars or even buses. And we have developed routes in different parts of the metropolis so that our people can get to their place of work. So that's one. Secondly, we are also trying to help reduce the burden on our healthcare system by coming up with an internal company-specific, let's say, COVID tele program. So it's a facility where our employees can do an online consultation with a group of medical practitioners who can help them, define, or who can help tell them what their symptoms mean. If an employee says, I'm experiencing this and this, without having to go to a hospital or consult a doctor, it's something that's specific to BDO in the meantime. So that's also our way of trying to help relieve any potential pressure on on the healthcare system, since most hospitals have already indicated that they are operating at full capacity. They cannot service all of the patients who come to them for medical attention.
Yeah, so I just have one last question. I mean, compared to the global financial crisis, are you better off today than you were in the past?
Maybe it's still too early to say whether we are better off today. I mean, in the global financial crisis, it was a credit event, right? So, I mean, we were still operating at full capacity, but we had to recognize markdowns, to say, in the value of our assets at the time. In this case, we are operating at 50% capacity, and there are a lot of constraints in terms of being able to do things the way we used to do. So, I think in the case of the global financial crisis, yes, we took a markdown in the value of our assets, but I mean, in terms of the ability to carry on business as usual, it was there. We were not prevented from doing so, unlike today, where I mean, there's a lot of limitations in terms of our ability to offer the full spectrum of products to our clients. So in a way, I think this is more difficult from an operational standpoint. Hopefully, from an asset valuation standpoint, hopefully this will not be as bad as the global financial crisis.
Yeah. Well,
Because,
we
again,
we have central bank support right now, which is
yes,
good, right?
we
Unlike
have
before,
central
it
bank
took a while.
support.
Yeah.
There's liquidity support. There are reliefs provided by the regulator in terms of asset quality recognition. So again, those are the things that, and the sooner we are able to help businesses get back on their feet, then again, the recovery process will hopefully come sooner rather than later.
I have one question from our institutional clients. This is as far as the corporate lending is concerned. Actually, they're more concerned about construction companies. What would your plan of action be if the projects of these construction companies are put on hold or pushed back?
Well, they are on hold at the moment, and I think what we expect is that once the lockdown is lifted, we expect construction activity to resume, both from the private sector and the public sector. I think the government has also indicated that they plan to resume the Build program when feasible. So in the case of the private sector, I think for the housing real estate developers, I think the plan also is to resume operations once the lockdown is lifted. So I think that we should see some resumption of activity in the construction sector.
Yeah, I think that's how they will generate the jobs for the unemployed. No?
Yes.
So mukhang tuloy na tuloy yun, no? For the fiscal policy.
And if you recall, the construction industry was actually suffering from that prior to this event. They were suffering from a lack of labor.
Yeah, it's true.
So now it will provide them the opportunity to get labor. I mean, for those who will be displaced by, let's say, hopefully we don't see a lot of company closures, but for those who will be displaced by that, then the construction industry can be an alternative sector for them to get into.
Okay, then there's another question here. How much is your exposure to SM, the Conglomerate, and SM Prime? Any insights on their credit given the large overhead of those companies?
Our related party lending, my memory serves me right, is I think somewhere between less than 2 to 3% of our total loan book. And given that they are a related party, I think we are secured by some form of collateral, usually in the form of deposits, also by other group entities. So we're not as concerned about the credit. I believe that the balance sheet of of our parent firm and SM Prime are very strong. They have a substantial cash position, and they have previously shown the ability to generate cash flows from both the retail and the mall operations. So now the mall operations are on hiatus, but I think once the lockdown is lifted and the malls are allowed to reopen, then we should see them going back to business as usual. I think consumers will likewise be hungry to go back to the way things were. I mean, after being holed up in your homes for one and a half months.
More than a month,
people will just be very eager to get out of the house and do something different.
Yeah.
And that should be good for consumption spending.
Yeah. And there's another question naman. Do you have exposure to POGOs? Be it through the buildings that they are occupying, like say offices, or to the employees?
We don't have direct exposure to POGO companies or to their employees. What we have exposure to would be their landlords, so people who develop commercial office space, which they rent, which the POGOs rent for their operations. And our commercial real estate exposure is roughly about 10% of our loan book. But again, we take comfort in the fact that our commercial real estate exposures are to the bigger names in the industry. So again, we are not as concerned about the quality of that exposure.
Yeah. Are these clean loans or are they collateralized for commercial real estate?
For the commercial, I think most of them would be on an unsecured basis. Because if you're talking the likes of Ayala, of Robinsons, or SM, in all probability they will be on an unsecured basis.
Okay. So, do you have any closing thoughts?
Well, no. I mean, I guess similar to everybody's wishes. Again, what we just hope to see is that we're able to get out of this sooner rather than later. And again, our wish is that we will be able to resume full operations just like everybody else and help our economy get back on track. So that should be, again, for the good of everybody, because then we will be able to provide jobs again to the people who are idle at the moment or to the people who will be displaced in certain sectors. So the sooner we're able to restart the economy, the better for everybody.
Okay. With that, thank you very much, Chito. And stay
thank you
safe.
too for giving us the opportunity. Yeah. Stay safe, everyone.
Even with the COVID-19 crisis, BDO continues to serve its customers. Second, half of its branches are still open, particularly in the provinces, and this has rewarded BDO by resulting to a continuous growth in its deposits. Third, it has also granted a 60-day grace period for payment of loan amortizations with no added interest and penalties to its customers. Fourth, because of the lockdown, BDO is seeing an increased adoption of its online channels. If customers continue to use the online channels even after the ECQ is lifted, then BDO would benefit as its costs would go down. On the negative side, business will be hurt because of the COVID-19 crisis. Loan growth is expected to slow down to mid-single-digit levels, while non-performing loans will increase. Nevertheless, BDO said that loans to tourism and travel industries, SMEs, and consumers are mostly collateralized, so they won't have to write off everything. A better assessment of how BDO will be affected by the ongoing crisis can be made once the ECQ is lifted so that businesses can continue to operate.